Hello everyone, my name is Agni Chaudhary and today I'll be discussing the major changes around Super in relation to the transfer balance cap and CGT relief and some situations to elaborate the application of ECPI on funds that have claimed the CGT relief. Now the Super changes are perhaps the biggest changes since the simpler Super rules came about in 2007. This webinar explores the challenges for trustees and accountants to comply with the transfer balance cap and application of the CGT relief, commencement and ceasing a pension, and how this affects ECPI in the annual return. Before we begin, for those of you who are unfamiliar with the GoToWebinar application, I'll brief you on some of the features very quickly. The orange arrow on the activity panel to your right allows you to expand or contract. Just a moment. The orange arrow again on the activity panel on your right allows you to expand or contract the screen and for most of you on the audio panel, you'll be switched on to the computer audio mode in the audio panel. For those of you who can't hear me, you may prefer a dial-up connection. Click on the phone call icon and you'll find the dial-up number, access code, and PIN on the audio panel. Kindly follow the prompts on the telephone after the dial-in. Further, the handout section is where you can download the handouts by clicking on the link. I've uploaded the handout of the presentation slides itself. There is also a commutation minutes template for those of you with clients above the 1.6 mil mark transfer balance cap, and that is available on the admin document section of trustdeed. So you can download that for those of you with clients above the 1.6 mil mark or TRIS and looking to commute their balances back to the accumulation. There is also a questions panel below and as marked in that red section, and you can type in your questions and click on the send button to send the questions. We will answer them later at the end. A small brief about myself before we begin this presentation. I'm a CPA SMSF specialist with over 7 years experience in SMSFs, and I also hold a Master of Accounting from Macquarie University. I have in-depth specialist knowledge in SMSFs, having administered, advised, or closely worked with over 1,000 funds. Needless to say, I'm very interested in this area of SMSF and the structuring opportunities that exist for my clients. My email and contact details are displayed, and should you have any questions, please contact me. In today's webinar, we will discuss mainly the new 1.6 million transfer balance cap, the CGT cost-based relief for the segregated and the proportionate method, some case studies on how funds will apply ECPI percentage going forward together with CGT relief, and finally, no discussion is complete without some key takeaways. So let's get into the discussion. The most important change in the new legislation is the transfer balance cap. Each individual in retirement will now be assessed against a new cap post 1st July 2017. The general transfer balance cap is now 1.6 million, which will index in 100,000 increments in line with CPI. This cap is effectively a limit on how much money you can move to retirement without having to pay tax. There is also a new definition of what is a superannuation income stream, and a TRIS is no longer included. What this means is that TRIS will no longer be considered to be a tax-free retirement income stream, and any earnings on TRIS will now be taxable. There is also a system of debits and credits in and out of the transfer balance cap, and an analogy could be made with the dividend franking account with its system of debits and credits. For instance, when you commence a pension, the value of the pension will count towards the transfer balance cap, and certain transfers such as commutations out of retirement will now create a debit. For instance, pension payments aren't a debit, lump sums by partial commutations are. This is important, and now you'll be looking at whether to characterize a payment as a pension or a lump sum, since taking a lump sum will reduce your cap, opening the possibility of moving further assets into the pension. Now the thing to figure out is to understand your position as on 1st July 2017. If a member exceeds their transfer balance cap, the member will apply to the trustee to commute or reduce their retirement phase interest by the amount of the excess, including the excess transfer balance earnings, to rectify the breach. The member will also be liable for excess transfer balance tax on their excess transfer balance earnings to neutralize the benefit received from having excess capital in the earnings tax exempt retirement phase. There will be a grace period of about 6 months, considering that the market value of assets will not be known till after the 1st of July 2017. This allows for amounts over the 1.6 mil, but less than the 100,000 increase to not attract the penalties. It's important to understand this. Cap is on amounts transferred into the retirement phase and not on the value of the retirement interest itself. For instance, if the value of the pension was 1.6 million and which then fell to 1.6 or 1.4 million due to pension payouts, this does not mean that you can move more money into the retirement phase, because you've already moved amounts up to the general transfer balance cap of 1.6 mil. At the same time, if assets grow in value, which cause the pension balance to exceed the cap, say, for instance, the 1.6 million mark becomes 1.8 million, this does not mean that the cap has been breached. The cap is marked on movements to the retirement phase. Once the cap is achieved, the movements in value within the cap don't matter. To work out whether your clients will be affected by the regulations, we need to first work out the client's retirement balance. In order to work out his retirement balance, we need to first work out the sum total of all his retirement accounts, be it pensions, excluding the transition to retirement income stream. This includes all the pensions, whether it is within the super fund or with other retail super funds, including other special income streams such as annuities or other defined benefit schemes. We then compare what he has as a sum total of his pensions and then compare it to the 1.6 million transfer balance cap. If the balance is less than 1.6 million, no change is required. The difference between the transfer balance cap and his total pension balance is what further amounts he can contribute to his retirement balance after the 1st of July 2017. If his retirement balance is greater than 1.6 million, he will then be required to remove the excess to ensure that only 1.6 million in retirement phase is in retirement phase on the 1st of July 2017. If a retiree has only account-based pension streams, then it is relatively simple. The member now has two choices. Number one, either commute the excess above the 1.6 million into accumulation, or number two, withdraw the excess as a lump sum. This excess may then be added either to an existing accumulation account, or a new accumulation account may be created for the member. Some retirees will therefore have an accumulation account for the first time in many years. Now, this means that these members will now have both accumulation and pension accounts from 1st July 2017, of which the earnings in the accumulation account will be taxed at a 15%. When this excess is added to an accumulation account within the same fund, an actuarial certificate will be required to claim ECPI in the coming years. If the excess were moved out of the super system, then earnings on those assets will be taxed at the member's marginal tax rates. The retiree is now faced with the choice of which is more beneficial. Number one, to keeping the money in super and earnings taxed at 15%, or withdraw it out of the super system and taxed at marginal rates. This will again depend on the retiree's marginal tax rates. Bearing in mind that any money moved out of super may often be an irrevocable decision, as there may be limited or no opportunities for it to be recontributed back into super. If the retiree has considerable wealth outside of super, it may be beneficial for him or her to leave the excess in super and taxed at 15%, and withdrawing substantial portions out of super when their wealth outside super diminishes. Things tend to get more complicated with a defined scheme. Each type of defined benefit scheme is non-commutable, meaning you cannot simply commute the excess balance or withdraw it out of super. If you have a defined benefit scenario, then the best thing would be to first commute from your non-commutable income streams such as an ABP or an account-based pension. If an excess still exists, the Act recognizes that the defined benefit schemes are non-commutable, and therefore no excess is deemed to occur and no penalties will apply. Defined benefit schemes are beyond the scope of this webinar, and we will not discuss them any further. People who have retirement balances above the cap will need to move some money out of their tax-free retirement phase prior to 1st July 2017. The excess may be placed in accumulation in super. Others who have TRIS will have their earnings on taxes on assets taxed at 15%. Effectively now, most people affected by the transfer balance cap will be paying more tax than post 1st July 2017. The reforms recognize this, and so they have provided some complementary relief to retirees affected by these changes. This will enable retirees to lock in some of the gains on assets under their current position. This ensures that only future gains will become taxable. The CGT relief is only for SMSFs who will be affected by the transfer balance gap and the TRIS changes. If the SMSF has no members in TRIS or no members requiring to commute balances to comply with the transfer balance gap, then they will not be able to avail the relief. If the SMSF is eligible for a relief, then it is applied on a per asset basis. The trustees must then have to make an election on a per asset basis, and very importantly, once this election is made, it is irrevocable. There are different methods to apply the relief depending on whether the assets were segregated or unsegregated in the pre-commencement period. This is a period between the 9th of November 2016, which was the day that the legislation was first announced, to 30th of June 2017. Essentially, the relief works by resetting the cost base of the asset on a particular date. We'll come to that a bit later. The fund thereby realizes a gain or a loss on the asset on its current market value, and this gain could be taxed based on its 2016-17 tax position, unless of course deferred, which we'll come to uh, uh, later. Now we've mentioned that the CGT relief arrangements will allow complying superannuation funds that choose to apply the relief to reset the cost base on assets that were reallocated or reapportioned from the retirement phase to the accumulation phase prior to 1st July 2017. The relief operates by assuming that the superannuation fund sold and reacquired the relevant asset for market value on a particular date. This deemed transaction triggers a CGT event A1 and results in the reacquired asset having its cost base set at its current market value. This will ensure that when these assets are sold after the 1st of July 2017, capital gains only arise in relation to future capital growth that occurs to those assets after the application of a CGT relief. That is, tax will only be applied to gains after they have been commuted. As the superannuation fund is taken to have sold and then reacquired the asset, applying the CGT relief would also reset the 12-month eligibility period for the CGT discount. CGT relief applies differently and is subject to different conditions depending on whether the superannuation fund segregates assets to support its current pension liabilities or whether it applies the proportionate method during the pre-commencement period. The following conditions apply to both the methods. Here, the superannuation fund must choose to apply the relief if they wish to do so. The superannuation fund must first make this choice and then notify the commissioner in the approved form, which will be the SMSF income tax return in a new format, on or before the day the trustee is required to lodge the fund's 2016 income tax returns, and not the day the return is actually lodged. So this is important. Remember we said earlier that the method would apply depending on whether the assets were segregated or unsegregated as on the 9th of November 2016. That is again the day on which the bill was first introduced. Now we will not travel too far to explain what segregation or the proportionate method are, except to say that under the segregated method, the assets are kept separate to support pension liabilities, whereas in the unsegregated method, assets are a mixed lot to support both pension and accumulation interest. Now, if the asset has to be commuted to accumulation to comply with the transfer balance cap, or because the asset were supporting a transition to retirement income stream pension, and the asset was a segregated asset between the 9th of November 2016, again the day the bill was first introduced for legislation, till the 30th of June 2017, then the asset is eligible for the CGT relief based on the segregated method. Here again, there are two methods for applying the relief. In the first instance, when trustees can either pick the specific assets to be commuted to an accumulation phase, or for that matter, even specific dates to apply the CGT relief. So let's say, for example, John had a 2.2 million pension, has 1.1 mil in segregated property, 700,000 in segregated shares, and a 400,000 in a bank account. Here the trustees can actually select $600,000 of shares to move to accumulation as an unsegregated asset, leaving a 600,000 accumulation balance if there were one member and a 1.6 million pension. In this particular situation, only the 600,000 worth of shares can then apply for the CGT relief. It has been clarified that for funds such as these, with balances of 1.6 million and above, they cannot apply the segregated method going forward and will have to use the proportionate method, which will then require an actuarial certificate in order to claim the exempt current pension income. The second option is for the trustee not to pick a specific asset due to owning a single large value asset. Say for instance when the 2.2 million pension was supported by a 1.8 million property and 400,000 in cash. In this situation, there is no 600,000 worth of assets that can be set aside and commuted back to accumulation, as the bulk of the pension comprised of a single asset, which was the property. In this instance, the trustee may choose the proportionate method and treat all fund assets as unsegregated assets from the date of commutation or 30th of June. Then at this stage, all of the assets are no longer segregated assets and all of the assets will be eligible for the relief. An actuarial certificate will again be required in the above situation. This may potentially lead to a better outcome since it now opens all the fund assets to the CGT relief. The market value used for applying the CGT relief and for resetting the cost base of the asset will be the value of the asset on the day the asset was no longer a segregated pension asset. This is the date the trustee could choose to apply the relief and reset the cost base. This is an important difference between the segregated and the unsegregated method. Under the segregated method, trustees could literally pick a given date to commute the balance and reset the cost base, which might not be the 30th of June 2017 market value. Especially if the 30th of June 2017 market value is not the highest value in the pre-commencement period. Here, under the segregated method, any gains or losses realized will be discarded as they are incurred on segregated pension assets, effectively locking in gains tax-free. So, let's now look at a case study to understand this better. Uh, John and Sinead have an SMSF. The fund holds a segregated current pension assets to support John's 2.6 million superannuation income stream and a segregated non-current assets to support Sinead's 1 million accumulation interest. Sorry. To comply with the transfer balance cap, John partially commutes the 1 million of his superannuation income stream back to the accumulation phase during the pre-commencement period. The fund is now faced with two options to allow it to claim the CGT relief. Option 1, the fund may continue to use the segregated method and transfer the assets between the two segregated assets pool. Or the fund may cease to use the segregated method and adopt the proportionate method. So let's see what happens when they continue using the segregated method. Let's say that on 1st of March 2017, to give effect to John's 1 million commutation, the fund transfers a parcel of shares with a present market value of 1 million out of the segregated pool of exempt assets into its pool of segregated non-current assets. The asset is eligible for CGT relief as it has ceased to be a segregated current pension asset within the pre-commencement period. The CGT cost base for this asset is $750,000, meaning that it has already accrued an unrealized capital gain of $250,000. To ensure that this accrued gain is not taxed when the asset is eventually sold, the fund chooses to apply the CGT relief arrangements to this asset. As the trustees of the fund, John and Sinead record this choice when they submit the fund's income tax return for the 2016-17 income years. The relief deems the asset to be sold and reacquired for its market value on 1st of March 2017. This will reset the cost base for the asset to 1 million. The 250,000 accrued gain is exempt since it is again a segregated pension asset. Importantly, it will also reset the 12-month period for the asset to be eligible for the CGT discount. CGT event A1 occurs in relation to the deemed sale and gives rise to capital gains of $250,000. However, as the capital gain arises while the asset is still a segregated current pension asset, the gain is now exempt from tax. Note, as John's total superannuation balance is now more than the 1.6 million mark, the fund will be required to use the proportionate method from the 1st of July 2017 onwards. As discussed before, it has been clarified that for such funds with 1.6 million and above, they cannot apply the segregated method going forward and will require an actuarial certificate in the coming years in order to claim exempt current pension income. Assuming the fund sells the asset on 30th of March 2018 for 1.15 million, another CGT event and capital gain arise at this time. Because the cost base of the asset is now 1 million, the fund makes 150,000 capital gains. The CGT discount applies to the capital gains because the fund held the asset for more than 12 months from the time the transitional CGT relief applied. The taxable proportion will reflect the proportion of the fund's superannuation liabilities that relate to John and Sinead's accumulation phase interest at that time. Alternatively, to give effect to John's 1 million commutation, the fund could adopt the proportionate method commencing on the 30th of June 2017. Under this method, 1.6 million of the fund's total assets, now worth 3.6 million, would be considered to be supporting John's income stream to this day. As the fund is seeking to apply relief to a segregated current pension asset just before the fund adopted the proportionate method, it must now use the CGT relief provisions related to the segregated method. It cannot use the CGT relief provisions relevant to the proportionate method, even though the fund now applies the proportionate method, because the asset was a segregated current pension asset at the start of the pre-commencement period. In all cases, all of the assets that were segregated current pension assets during the pre-commencement period would be eligible for CGT relief because they all ceased to be segregated current pension assets on 30th of June 2017. The fund could choose to apply a relief to some or all of these assets. The relief will reset the cost base for the chosen assets to their market value immediately before the cessation time, which is the 30th of June 2017. It will also reset the 12-month period for the assets to be eligible for the CGT discount. Moreover, the capital gains that were generated by the application of the relief would be exempt from tax, as these gains would arise while the assets were still segregated. If an asset to which the relief applied is sold in a later year, a proportion of any net capital gains will be taxable to the fund. The taxable proportion will be determined by an actuarial certificate and will reflect the proportion of the fund's superannuation liabilities that relate to John and Sinead's accumulation phase interest at that time. Using a very simplistic example, if the fund had property worth 1 million and units in a unit trust worth 1 million besides the parcel of shares, the trustees can now pick and choose either one or all the assets for reset of their cost base to the 30th June 2017 market values. A very important and not the date that they cease to be current segregated pension assets as in the previous scenario. This may sometimes lead to a better outcome as it potentially opens all the assets of the SMSF to the cost-based CGT relief. Compared to the segregated method, the unsegregated method is much easier to apply. Where your funds were unsegregated during the pre-commencement period and the fund commutes to accumulation to comply with the cap or because it is a transition to retirement income stream, if so, all the unsegregated assets are eligible to apply the relief. This is because under the unsegregated method, no specific assets are attributed to support a pension, and all assets are affected by having to move assets out of their tax-free retirement phase. The unsegregated CGT relief must be applied on the the 30th of June 2017. And similar to the segregated method second option, the fund is deemed to have sold and reacquired the asset on the 30th of June 2017. The cost base of the asset is reset at that time for its market value. This deemed a transaction triggers a CGT event A1. The value of the asset on the 30th of June 2017 is used to determine the gain or loss, and the cost base is reset to that market value. The gain or loss is recognized in the 2016-17 annual return, just as if the asset was actually sold during the year. If this results in a net capital gains, this will add to the fund's assessable income, which will then depend on the fund's exempt current pension income. On the other hand, if this results in a net capital loss, this capital loss may be carried forward to the future. The trustee also has a choice to defer the capital gains on the asset. If this were elected, then there are special rules in calculating the notional capital gains that are required to be carried forward. This notional gain is actually taxed in the income year in which the assets are actually sold. I will use an example later in the webinar to broaden our understanding of this issue. Now let's look at another case study where a fund applies a CGT relief using the proportionate method. So Barbara and Peter have an SMSF which is supported by a property which they bought in 1999 with a current market value of $3 million. The fund uses the proportionate method to calculate the proportion of income from the asset, that is exempt income, with two-thirds of the asset supporting Bob's 2 million superannuation income stream and one-third which is supporting Peter's 1 million accumulation phase interest. Now to comply with the transfer balance cap, Bob has to partially commute 400,000 of her superannuation income stream back to the accumulation phase on 30th of June 2017, leaving her with a retirement balance of 1.6 million. The cost base of the property acquired in 1999 is 2.82 million, meaning that it has already accrued unrealized capital gains of $180,000. The fund chooses to apply a CGT relief to ensure it does not have to pay CGT in the future for the proportion of the assets that supported Bob's superannuation income stream that was commuted as a result of the introduction of the transfer balance cap. The asset is eligible for relief under this method as it was subject to the proportionate method for the entire pre-commencement period. The relief deems the asset to have been sold on the 30th of June 2017 and reacquired immediately thereafter for its market value. This will then reset the cost base for the asset to $3 million. It will also reset the 12-month period for the asset to be eligible for the CGT discount. CGT event A1 occurs in relation to the deemed sale and a capital gains of 180,000 arises from that event. If the fund does not elect to defer the gain will be brought to account in the 2016-17 income year. we will these are all the scenarios that we've just spoken about. It's the house with 3 million and which was bought into 0.82 mil. And now, what if let's say the capital gains was not deferred? If it was not deferred, the one-third CGT discount applies to the capital gains because the asset was held for more than 12 months prior to the deemed sale. Assuming the fund had no other CGT events or prior year CGT losses, the fund will have a net capital gains for the 16-17 income year of $120,000. Show it to you. Which again is the 180,000 capital gains less the one-third CGT discount. Now, due to Bob's commutation on the last day of the financial year, the fund's average exempt pension for the 16-17 year will be slightly less than two-thirds. Let's just say it's 60% exempt and 40% taxable. Therefore, approximately $48,000 will be included in the fund's assessable income for that year, representing the amount of the gains attributable to the proportion of the fund's assets that was supporting Peter's accumulation phase interest. Bear with me for a second. All right. So approximately the 48,000 will be included in the fund's assessable income for that year, representing the amount of the gain attributable to the proportion of the fund's assets that was supporting Peter's accumulation. If now let's look at another situation. Now, the choice to defer the capital gains arising from the CGT relief, the important points behind it. The super fund also has the additional choice to defer capital gains that arises from the fund choosing to apply the CGT relief. Remember, the choice to defer does not arise in relation to a capital loss. Also, the choice to defer the capital gains must be made in the income tax return, and moreover, the choice cannot be has to be selected. The immediate consequence of the superannuation fund deferring the capital gain is the capital gain is disregarded. This will ensure that the capital gains is not brought to account in the 16-17 income year. What the deferral actually does is that it defers the capital gains to a future income year when the asset is actually sold. Once the hypothetical net capital gains amount is calculated, the deferred notional gain can be calculated as the non-exempt proportion of the gain. The non-exempt proportion is the amount of the net capital gains that would have been subject to tax in the 16-17 year if the deferral had not occurred. Also the non-exempt proportion is worked out as the proportion of the total superannuation fund's unsegregated assets that supported the superannuation benefit liabilities uh, other than the superannuation income stream benefit liabilities throughout the 16-17 income years. And very importantly, this will require an actuarial certificate in order to claim the exempt current pension income. If the CGT asset is sold or otherwise realized, that is, there is a realization or a sale event on or after the 1st of July 2017, then that deferred notional gain is brought to account in that income year and the realization event happens. It was originally proposed that the duration of the deferral would be a maximum of 10 years. Uh, we have received word that this has subsequently been revised, and now as things stand, uh, uh, the trustees may continue to defer indefinitely till the asset is sold. Now let's look at another case study here where in the earlier scenario, uh, if they did not elect to defer the capital gains, then Bob and Peter's SMSF would just have included would include just over $48,000 in its assessable income in relation to the deemed sale of the fund's asset in the 16-17 income year. If the fund instead chose to defer the capital gains, the fund's deferred notional gain would be the same amount. The capital gain would be disregarded in the 16-17 income year, and the deferred notional gain would be brought to account in a future year. From the earlier analysis, imagine that the fund had an unapplied net capital loss from a prior year of $90,000. If the fund chose not to defer the capital gains, its net capital gains would be $60,000, which is calculated by reducing the gain of 180,000 by the net capital loss of 90,000 from a prior year, and then applying the 1/3 CGT discount. Once the exempt proportion from the 16-17 income year, which is 60 percent as assumed in the question previously, is applied, an amount of just over $24,000 would be included in the fund's assessable income for the 16-17 income year. However, if the fund chose to defer the capital gains, its deferred notional gain would still be just over $48,000 and not $24,000. Recall the earlier gain calculated before applying the capital losses. Because capital losses, again, are disregarded in working out the deferred notional gain. The fund would then have 90,000 unapplied net capital loss, which to apply against future capital gains, including the gain that arises when the deferred notional gain is brought to account. Continuing with the same example, let's assume that in 2021, in June 2021, the fund finally sells the asset for 3.3 million. The general CGT provisions apply to the sale, giving rise to CGT event A1 and a capital gain of $300,000. The CGT discount applies to this gain because the asset was again held for more than 12 months after CGT relief was applied. The sale of the asset also requires that the 48,000 deferred notional gain is to be brought to account for the 2020-21 income year as a capital gains. The fund's net capital gains then is, let me just open that for you, is just over $248,000, which is actually the $200,000 for the discounted capital gains on the sale, plus just over $48,000 for the deferred notional gain carried forward. Assuming that the fund's exempt proportions for the 2021 income year is calculated at 50%, which is Bob's remaining income stream, retirement income stream, as a proportion of the total value of the fund. However, this exemption obviously does not apply to the deferred notional gain, as the deferred notional gain amount has already factored in the 2016-17 exempt proportion. As such, the fund's assessable income for the 2020-21 income years is just over $148,000, which is 50% of the $200,000 component of the net capital gain plus the deferred notional gain of $48,000. So let's now just recap some of the important rules for the CGT relief. We've already mentioned here that the election is irrevocable and is made in the income tax return, and this is made on the day that the fund is actually required to lodge the 16-17 tax return, and not on the day the tax return is actually lodged. Also, the election is made on a per asset basis, and the choice whether to apply the relief actually rests on the trustees. So it is not mandatory on the trustees, and he can always sort of exercise that choice based on the best possible result for the fund as a whole. Also, proper records, documentation. Now, this is very important, and obviously need to protect yourself, and especially those with 1.6 million and looking to use the CGT relief. You must have a proper documentation going forward. In the event the ATO, conducts an audit and may land yourself in big trouble. Finally, the superannuation fund applying the CGT relief must be a complying fund for that duration of the pre-commencement period. Yeah, well, that I would assume is pre-assumed in this scenario. All right, now finally I would like to mention that no discussion is complete without some key takeaways. So what can advisors do with the current legislation? Well, I can only think well, some of the things, suggestions or thoughts that come to mind are, number one, they may characterize the amounts above minimum pension withdrawals as lump sum withdrawals. Remember, we said previously that any commutation from the pension account will count as debit to the trial transfer balance cap. This will again open the possibility of moving more money into the retirement phase. Number two, they can also apply CGT cost based relief on an asset by asset basis, very carefully analyzing each and every asset. So each asset should again be judged on a case-to-case individual basis. So for instance, a business real property that is supporting a family business and unlikely to be sold would obviously not apply for CGT relief. Likewise, a property with high capital gains trapped for several years will more often than not apply to the relief. So again, it depends on the situation. It depends on the assets. It depends on the condition of the fund and the ages of the members. So there are several variables that one needs to look at. Again, we may consider a situation when a fund has a member looking to go into retirement in the next few years, and so a significant proportion of the earnings on assets will then become exempt. So here it may be a good idea not to claim the CGT relief on the asset for the 2016-17 year and wait till that particular year when the gains will anyway become tax exempt. Finally, the recontribution strategy, which we speak about so often, especially with clients with very disproportionate balances, husband and wife. Uh, so the bring forward rule will may enable you to put in $500,000 for the current year, and also up to $300,000 from in 2016-17 and the future years. What the recontribution strategy actually does is that it is then money is then withdrawn and then applied to and put back into the fund and put into the spouse's account, the one with the lower balance, thereby increasing their balance and also favorably altering the tax components of their benefits. This strategy has some limitations, obviously. The most important being that members aged 65 and above cannot use the bring forward rules. So this again cuts out a majority of perhaps your clients. They will all be above 65 and above, I would assume. And before we finish, now we have to like to take this opportunity to brief you on two new websites that we have launched. The first is smsfdeed.com.au. The value proposition for this one is that you can apply for a corporate trustee, SMSF, and an AB and TFN all in a single application form. The cost is $125 for the SMSF and an extra $40 for the corporate trustee plus the ASIC fees. The ABIN registration is free of charge. Now this is a terrific website, and the beauty is that it is fully integrated with ASIC, and then we also launch your AB and TFN with the ATO. We can also integrate this website to your website, which may enable you to capture some of some website traffic, and of course you can make some money along the way. The second website is ecpr.com.au. Now the best value proposition for this website obviously is the price, which can be as low as $55 depending on the number of certificates bought. So we sell bulk packs on this website. Well, this I believe again is a significant savings for you from the actual certificates point of view, because normally actual certificates could sell up to $176 per certificate. The other great feature about this website is the design aspect. So if you've used Trustdeed so far, I urge you to try this. It will save you half the time and also cost you half as much. Commutations and pension commencements are intelligently picked up by the system, and you have to enter them only once. And so no more data mismatches. We've also combined pension accounts and accumulation accounts. So again, the form is only half a page long. Well, if you want to discuss both of these, then please contact me on on my email ID. So again, we've come to the end of the webinar. We will just look at some questions which have been, or we have several questions, briefly looking at some of them. Okay. Okay, so now there was a question which says, why do you say withdrawals above the minimum pensions are lump sums? Well, again, like I said, because we characterize them as lump sums, so as to get a debit on the pension side and then withdraw it as a lump sum from the accumulation, opening up the possibility of further incomes moving into the pension account. So you didn't actually cover off on when an actual certificate. So for okay, now there's another interesting question. Where can I download the declarations for commuting amounts over the 1.6 million mark? Okay, now the declarations, again, I have advised, is available both on online SMSF audit and trustdeed. So what you need to do is, if you have done an SMSF through us, so it sits under the finished paid documents section, and there are two columns, one of which is the SMSF, the admin documents, and the other one is the download download documents section. You need to click on the admin docs, and then it takes you into a different page, and then it has a number of these commutation templates and a lot of other useful templates. You need to check that out, and you will find the rollover or the commutation minutes over there. Uh, well, let's. Okay, there are quite a few questions, so I obviously will need to spend a lot of time answering them. I prefer to do that. I will probably send an email just for people who have raised their questions. Okay, so once again, thank you very much for attending the webinar, and although this webinar does not address all the issues associated with the latest changes, hopefully it provides a useful insight into the breadth of issues that must be considered while applying the relief, and the most common issues around actuarial certificates and when you need to commute your balances and then apply for an actuarial certificate. We will appreciate any valuable feedback on queries which you can direct at agni@trustdeed.com.au. Goodbye, and thank you, and enjoy the rest of your day.